Hello and welcome to CMC Markets Trading Outlook for the week of April the 11th, 2016. My name is Colin Szysinski, Chief Market Strategist. This week we're going to do a number of previews for events that are coming out this week. We're going to start by looking ahead to earnings season. We're going to look at a big week for data from China. We're also going to look at upcoming central bank meetings for the Bank of Canada, for the Bank of England, and we'll also give an update on where crude oil is heading towards its big meeting later in the month. We're going to kick off though with earnings season and the U.S. markets, and I think we've seen a lot of choppiness over the last week or so as people have been trying to figure out what's going on heading into earnings season. If we look here at the chart for the U.S. 30, we'll see that the markets plunged in January. And what was interesting was that this was heading into the last earnings season. We had this big drop, twofold happening here. One was related to the sell-off in China, but the other one was it was just ahead of Q4 earnings season. Once earnings season got going, we had to bounce a little bit. Then we had a retest though near the end of earnings season, and then the market started to take off. What's important here? We had a big shift in expectations surrounding earnings last quarter, and if you'll recall, most of the reports that came out for Q4 were really strong Q4 and awful guidance for Q1 and for 2016. Companies were not very enthusiastic about the new year. A lot of them were complaining about the higher US dollar. Energy prices were tumbling, and things weren't looking all that great, certainly the corporate side. But the other story that we saw play out through the first part of this year was that while the stock markets were tumbling and traders were pessimistic and companies were pessimistic, the US economy itself, the Main Street economy, continued to do extremely well. And what's interesting as we go into this earnings season is, so far, if you look, there was a huge drop in their earnings last time. This time around, the drop is pretty minor, really, and it's more of a sideways correction than a big downward correction. The other thing that's important to note here is that we're going through confession season when companies put out their profit warnings, and there's been hardly any profit warnings. I suspect that the economy in the U.S. has been a little better. The U.S. dollar has come back down a little bit, easing some of the pressure, some of the forex pressure off of U.S. companies, and we could be setting up for a fairly decent earnings season. Now, the question is, how much has this rally over the last 6 weeks built in expectations? Well, we're kind of back to where we were in November and December, so we're certainly not looking at anything stronger than what people were thinking in late 2015. So I think expectations are still fairly moderate and subdued, and so we could be in for some positive surprises as we move into earnings season. That'll be interesting to see. In terms of the markets had gotten oversold by the end of January and the middle of February. By the end of March, the U.S. market had gotten quite overbought. We've had a correction here, but look, the RSI is holding the 50 line. What does that mean? We're in a correction, but we're still in an uptrend. So maybe we see the Dow pull back here at some point into this low 17,000 range, 17,180-ish, but probably not back to retesting anything back here anytime soon. And particularly if U.S. economic news has been pretty good of late, for the most part, and the Fed is still talking about raising interest rates twice this year. Even the doves at the Fed are still talking about raising interest rates twice this year. So that's an indication that the economy is still continuing to chug along, setting up for some potential positive surprises as we head into earnings season. The company that kicks earnings season off, of course, is Alcoa. And they've been base building here. I mean, the shares had a big sell-off along with commodity prices through most of 2015. Bottomed out in January here. Nice hammer candle at the bottom with an oversold RSI. It's been creeping back up, and it's had a nice bounce from 6 to 10. But really, it's just kind of sitting in this range that's predominant here of about 750 to about 1050, 11. And Alcoa is just sitting in this. So the expectations, I don't think, are unduly high at this point. Look at this also. The 50-day moving average keeps gaining on the 200. What does this mean? It's getting close to a golden cross. That could be an encouraging sign for Alcoa as well. So I look for Alcoa potential for a positive surprise. Commodity prices have started to rebound a little bit, and the economy's been decent, so we'll see if that plays out in the demand for metals. The other big sector in the U.S. that's reporting this week is the banks. On Wednesday, we have JP Morgan. Thursday, Bank of America and Wells Fargo. Friday, we have Citigroup. I'm going to show the chart for Citigroup as an example. of what's going on. And the reality is for the US banks, expectations are very low. We actually saw the banks peak back in July, one leg down, we've had two leg downs, we've had a bit of a bounce here and it's kind of been rolling over again, hanging in and around $40 here for Citigroup, the 52-week low, about 34.50. And there's been a lot of talk lately about what about defaults, what about in the U.S., particularly, and exposures to the oil and gas sector. Now, things have at least seemed to stabilize a little bit in the oil price, and eventually companies will get used to operating at a lower price environment. But it's like anything else, there is a transition here. We're still seeing quite a bit of fear in the U.S. banks, and the question will be, even though clearly there's negative exposure to operating companies and to real estate in the oil-producing areas, the question now is, what about the rest of the country? The rest of the country seems to be doing reasonably well, and so will that offset the potential weakness in one area, particularly the oil and gas sector and that middle part of the country that's dependent on oil and gas revenues. Moving forward now, the other thing it's a big week for is China data. We have this week coming out. We kick off on Sunday night with consumer and producer prices. On Tuesday night we get the China trade balance, and on Thursday night we'll get GDP, industrial production, and retail sales. So it's a big week for news out of China. And as I showed on the markets, that fears about the Chinese economy collapsing had driven stock markets down, but at the same time it looks as though that was overdone, and that the China's economy hasn't gone off the rails the way the market predicted, and that we'll be looking to see as that confirmation, particularly from the GDP report this week. So if we bring up the Hong Kong 50 here, tracks the Hang Seng, we'll see. I mean, it had a massive rally a year ago. I'm going to take this chart out a little longer, show the rise and fall of this thing. I mean, last year when the market was absolutely exploding upward, nobody complained. Then when did we have 1, 2, 3 legs down? This has completed the triple waterfall, and it's got massively oversold back in January. The big sell-off in January, if anything, was more like the final flush, unwinding this massive bull market it had previously. China's economy, it seems, has continued to muddle along, and that's what we'll be looking for in China-sensitive markets. We've had a reverse head and shoulders base here, ascending triangle. We've broken out of that. We're holding above the breakout point. RSI again is in an uptrend as well. Even through this correction, it's kind of stabilized around 50, and so now we're seeing 20,000 holds for the Hang Seng, 21,000 initial resistance. Does it continue to bounce around in this area, work its way higher, or break down? We'll see. That'll depend on the data as it comes out through the week. But certainly China markets and China-sensitive markets could be quite active throughout the week. We'll also I'm also going to highlight here copper, which is intriguing. Copper is one metals market that's quite sensitive to China. We can see a big sell-off. But interesting here, when the Chinese market crashed in January, the copper didn't really go down that much. It's also built a reverse head and shoulders base, kind of working its way up. Now it came back. It's gotten oversold again and trying to stabilize here above the $2 level and shoulder support. So we'll see if this can start to rebound. The moving averages here, we also have the 50-day gaining on the 200, but it's not quite as close to a golden cross as we saw in Alcoa, so we may see more interest in individual stocks first over commodity prices, but copper could be an active trader through the week. While I'm on the topic of Asia-Pacific markets, I just want to show the dollar-yen here, which has had a explosive move over the last week or so. This market had been trading kind of in a range here. Let's go to a little longer term here. There. So this had been in a range here of about 111 to 1. That's about 115. Let's call it 114. Really was the main resistance here, and the bottom fell out from under it. This measured move from 114 to 111 took you down to 108. And look at this: you dipped below it in what looks like a selling climax or a bull trap reversal. Now back above it. So this 108 measured objective does seem to be holding so far, having an inside day. We'll see if this continues to stabilize. RSI has become quite overbought, as we'd seen a couple of times previously in the last few months already. So not overbought, oversold, I mean. Oversold on the RSI. This has to get back above 30 though to signal the downward pressure starting to ease. But we had seen the yen explode to the upside against the dollar, against the Canadian dollar, against the euro, and a lot of other currencies, and it's gotten pretty overextended here. So it is possible we might see a reversal or some kind of consolidation in the coming week. While mentioning the Canadian dollar, I'll move on to that now. And this week we have two central bank meetings. The first one is in Canada, and we're seeing here that this is US dollar CAD, which we can see had a big downtrend. It's been bouncing around between about 129 and about 133, and it's quietly working its way below that. Look at this, RSI faltered at 50 and is starting to come down. And here, Canadian jobs report, Canadian dollar strengthening. I'm just going to flip the pair over here and show this rally because it's quite something. If we look here at CAD US dollar, really nice channel uptrend here. We've been in a normal trading correction consolidation here. RSI has gone from overbought but holding 50. That means the underlying uptrend is still intact and the overbought conditions have eased. This has held 75. It's back above 76 with first resistance in and around 78. But look at this over here. You can see that just exploded upward from 76.40 to 76.90, adding half a cent in a few minutes. This was on the much better than expected Canada jobs report. 40,000 job increase rather than 10 the street had expected. Most of that was full-time, which was also encouraging. And apparently Alberta was leading in job creation, which was particularly encouraging considering how hard that province has been hit by the oil price crash. So things were lining up really good for Canada. On top of that, housing starts were strong for a second straight month. February revised upward. March still beat the street on top of that. And my feeling had been that February housing starts might have seen some pull forward because the weather had been decent and the winter hadn't been so cold this year in Canada. But we're still seeing really good ramp up in housing starts. So we'll see if that carries through till April. But for now, things are looking pretty good. The next one to cover is the Bank of England, and I'll move over to sterling dollar here. And when we look at cable's an interesting one because there's a few things going on. This first down leg here, a lot of which is related to the Brexit referendum. This first leg down here was when expectations changed at the Bank of England from a rate hike in early 2016 to no rate hike until at least after the Brexit referendum and possibly not until next year. That was that leg down. This next leg down here was when the Brexit referendum got called and people started picking sides. We've had a couple of more downdrafts here. This one here was related to some cabinet resignations and strife within the Tory party over the vote and who's on which side. And this last downdraft here was between the Netherlands voters, showing that there's a lot of discontent with the EU and some issues with Cameron and his personal finances. But still, what's most interesting about this though? Now, after this first wave down here into a head back at the end of February, we're seeing 140 emerge as a pretty good support level and more about 140.50. Even more significant, look down here, consistently higher lows in the RSI. That means each time we're getting one of these Brexit-related tumbles, though, the pressure is not as great, and we are seeing slowly but surely this is carving out a base. However, because of the uncertainty over who's going to win the referendum, it's looking like a pretty close race. We could still see continued choppiness in cable over the next few months. So that covers most of the main developments for next week. I will just mention a couple of other things briefly. We do have a few Fed speakers through the week, but it's mostly regional Fed presidents. None of the big three are scheduled to speak in the coming week. For U.S. data, we do get a little bit on Wednesday. We get retail sales and producer prices. Thursday is consumer prices. Friday is empire manufacturing and industrial production. So we could see a bit more action in the U.S. later in the week as the week progresses. But overall, it looks as though there's a lot of things going on. We'll start to see more of a balance between looking at individual stocks and some of the big macro and monetary developments that have been driving markets over the last few weeks, and so should shape up for quite a bit of activity. One last thing to look at here is the crude oil price, which is showing some nice signs of recovery here. It had been under a heavy downtrend. Initial recovery got quite overbought here, so we've had a trading correction. But look at this: we've seen support come in about 34.60, much higher low, and then the markets have started to rally up off of that. We are heading towards the big producers meeting being held in Qatar a little later towards the end of this week on the weekend, I believe. So we do have that coming up. We'll probably see quite a bit of speculation at that. Wider trading range for crude oil is about 34.55 to about 40.50, let's call it here, and 40.90, and so we could still see it bounce around. If it does start to clear the $40 level, could be quite encouraging as well. It does show that expectations are improving. Also, we're coming off what was a really nice big drawdown in U.S. inventory, so be careful this week in and around the API and the DOE numbers, because we had big drawdowns. Will we see a reversal or will we see a confirmation? Those numbers could also spark significant trading in crude oil.